Welcome back, everyone. Today, we're zeroing in on a massive economic force, a group that's, quietly reshaping everything from the stock market to the luxury goods industry. We are talking about sinks and dinks. Okay, let's get right into it. First things first, let's get a really clear picture of who we're actually talking about here, and more importantly, why they've become so significant. It all comes down to these two acronyms, SINK, that's single income, no kids, and DINK, which stands for dual or double income, no kids. Really, at its core, this is a fast-growing group of people who are choosing not to have children for a whole lot of different reasons. Now, you might look at that and think, okay, 5%. That's a pretty small slice of the pie, right? In the US, DINKs only make up about 5% of the population. But, and this is a huge but, their economic impact punches way, way above their weight. And this is where it gets really interesting, seeing how this whole trend is playing out around the world. We're going to look at two super different places, Singapore, the dense city-state, and the sprawling United States, to see what's really driving this shift. And this slide just lays it out perfectly. Over in Singapore, you've got these immense financial pressures. People talk about the million-dollar child, there are tough housing policies for singles, and of course, a super high-stress work culture. Then jump over to the US and you see a different set of drivers, a historically low national fertility rate, people putting off big life milestones, and the number one reason you hear? The rising cost of just about everything. So different pressures, but they lead to a very similar outcome. So here's the real takeaway. It doesn't matter what the local factors are. The big underlying motivation is this global cultural shift. More and more people are putting a premium on their personal freedom, on climbing the career ladder, and on spending their money on experiences, not necessarily on raising a family. So let's follow the money. How does this lifestyle choice translate into actual raw economic power? This is exactly where that little 5% population number becomes totally misleading. Just take a look at this. In the United States, DINK households are seriously out-earning pretty much everyone else. A whopping 60% of them are pulling in over $100,000 a year. That level of disposable income, well, it changes the entire game. And if you want to see what that disposable income looks like in the wild, here it is. American DINKs spend around $816 a month just on dining out. Compare that to the average American at $215. I mean, that's nearly 4 times more. It's not just a little bump, it's a whole different league of consumer spending. So it's really no surprise that big brands and financial institutions are looking at them this way. When you don't have those huge expenses like childcare or saving for college, that money has to go somewhere. It flows right back into the economy, fueling demand for luxury travel, high-end goods, and, of course, creating a giant pool of cash that's ready to be invested. Which, brings us to the next big question. With all this extra cash that isn't going towards family costs, where are they putting it? How does this group actually invest and build their wealth? Well, the sources we looked at point to this really fascinating investment mindset, and they call it the barbell effect. It's basically a strategy of extremes. You focus on two completely opposite ends of the risk spectrum, and you pretty much ignore everything in the middle. And here's what that barbell actually looks like. On one end, you have these high-conviction, really aggressive investments hoping for massive growth. Then, on the complete other end, you have super safe, guaranteed yield stuff for stability. And what's missing? That whole traditional moderate risk middle ground that's usually tied up with long-term family planning. Let's break that down even more. That high-risk side means a ton of capital is flowing straight into the stock market, targeting those high-growth areas like big tech and AI, or even digital assets like crypto. The safe side is held down by things like bonds and fixed deposits. And then you have this other fascinating category, alternative assets. We're talking luxury watches, art, premium real estate, things that are both an investment and a direct lifestyle upgrade. So what does this all mean when you zoom out? What are the huge seismic shifts that happen in an economy when a growing, high-earning slice of the population just opts out of the traditional family model and starts investing their money in a totally different way? Well, the sources point to a major long-term headache for both governments. In Singapore, it's making the silver tsunami worse. That's a rapidly aging population with fewer young workers to support it. And in the US, you hear very similar worries about funding social safety nets like Social Security and Medicare, which depend on contributions from a large workforce to support a growing number of retirees. That whole balance is fundamentally changing. And that kind of leaves us with this big, provocative final thought. This isn't just a bunch of individual personal choices anymore. It's a massive redirection of capital. As wealth shifts away from building the next generation and instead flows directly into the market and high-end consumption, you have to ask, what kind of future economy are we all collectively building?
If this explainer helped you see the economy in a new light, doing us a solid by liking and subscribing helps this get out to more people. Thanks for tuning in.